Many investors practice tax loss selling or tax loss harvesting towards the end of the calendar year. In most cases, this involves selling securities that are currently valued at a lower price than they were at the time of purchase to possibly reduce income and ultimately pay less in tax for the year. In this webinar, we welcome Georgia Swan, tax and estate planner at TD Wealth, and Tannis Dawson, high net worth planner at TD Wealth. They'll explain some of the key terms and concepts that investors need to know to understand how tax loss selling works, the potential benefits and risks of tax loss selling, and some best practices for portfolio management ahead of the tax season. So I welcome my guests, Georgia and Tannis. How are you?
Good. Thank you for having us today.
Hi, Ryan. Good to see you again.
Well, it's really nice to have you all here. So let's start with the biggest question here. What is tax loss selling?
Well, essentially, I know that most investors never want to think that any of their securities are in a loss position. But what tax loss selling involves is the sale of securities or shares at a time when their fair market value is less than what their adjusted cost base is. And basically what happens in that case, essentially that the price that you're selling them for is less than the price that you bought them for on a simplistic level. And what happens at that point is that you realize a capital loss. And those capital losses can be useful because they can be applied against capital gains back 3 years or held on and carried forward indefinitely.
Okay, so there was a lot in that. So let's try to unpack some of that terminology as well for our audience. Let's start with that fair market value. So what is fair market value?
So fair market value for securities is what you can sell it on, usually the stock exchange, because your securities are held on some type of exchange. And so what you're going to be able to get it for. And so whatever you can sell it for, that's your fair market value. And then you take off any fees.
And you also mentioned capital loss, capital gain. Now, when we talk about gain or loss, what makes a difference when we're talking about a capital gain or a capital loss? What is that?
Okay, so where a capital gain starts is the difference. Again, we're getting into these tax concepts or accounting concepts. It's basically the difference between your adjusted cost base and the proceeds of disposition. Now, the same or similar to how proceeds of disposition starts, your adjusted cost base starts with the value that you purchased that particular securities at. However, once again, as with proceeds of disposition, there are certain amounts that may get added to or perhaps subtracted from that number. So the capital gain is basically the difference between those two numbers, your adjusted cost base and your proceeds of disposition. Again, for accounting purposes, you may hear that adjusted cost base being referred to as the cost. But for tax purposes, we use terms like proceeds of disposition and adjusted cost base. And the capital gain is when your adjusted cost base is less than your proceeds of disposition. A capital loss results when your adjusted cost base is higher than your proceeds of disposition.
Okay, I see. So, and when you talked about the disposition or the proceeds of the disposition, what did you mean by that?
So if you sell something, they call it a disposition, so that you have now gotten rid of it. So you're disposing of it. Sometimes where on death, you're still holding those securities, so they'll call that a deemed disposition. So technically, I held it on my death. Now it goes to my estate. But the way the tax rules happen is now they've deemed you sold, so that it wasn't physically sold to anybody else, but for tax purposes, that's a deemed sale.
Okay. So in this situation, in this tax loss selling situation, we sell in order to kind of get that capital loss. Can we just buy back that same stock? If we really didn't want to sell it, we just wanted to use it as a capital loss, why can't we just buy that same stock back? And at least hold it at that point?
Yeah. Well, the Income Tax Act has a number of rules called the superficial loss rules. And basically what these rules state that if at the time you have realized this loss, you or an associated person, either within 30 days before you trigger the loss or 30 days after you've triggered the loss, then reacquired the same securities, that loss is actually denied. What happens is that loss gets added to the adjusted cost base of the new securities that you reacquired. And so therefore, that loss is not taken into account until you sell those new securities. Now, what does it mean to be an associated person, affiliated person? That's the term, affiliated person. So affiliated persons to you are, of course, you. I mean, if you sell shares in ABC Corp today, and then 15 days and realize a loss, and then 15 days later you buy shares again in ABC Corp, you will trigger the superficial loss rules. However, it also includes your spouse, a corporation controlled by either you or your spouse as well. So if, for example, my spouse purchases shares in ABC Corp, and then 15 days later, I sell my shares in ABC Corp and realize a loss, then that loss will be denied under those superficial loss rules. And it's important to know that when we're talking about identical securities that you might purchase, it includes the same company units, the same exchange traded funds or mutual funds, or a competitor exchange traded fund or mutual fund that invests in the exact index that was sold. Okay, so those are some of the things that oftentimes, because these rules are so specific, and as I said, for an example of this is, for example, an ETF. You sell one ETF, you buy another ETF that tracks the same index within that 30-day before or 30-day after. That can trigger the superficial loss rules. And that's something that is often the thing that causes people to not realize they're offside.
Okay, so that begs the question then, can I use this tax loss selling in a TFSA or even an RSP?
No. So what happens is if we were in that situation, it's worse because the superficial loss rules at least gives us back to the cost base. The way when a TFSA, if I was in that situation, I had the cost base at 10. I sold the fair market value at the date of the transfer to the TFSA is 9. When it goes to the TFSA, I'm going to have a cost base of 9. So I have now lost that dollar of loss and I'll never get it back. Now in a TFSA, we don't care about the growth part of it because we're never going to be taxed on it, but we've lost that dollar loss that we could have benefited. But if you're doing this to your RRSP, then there's a double negative because you have now, you got denied the loss and we can't add it to the cost base. And in the RSP, you're going to be taxed on all the growth 100% because every dollar coming out of RSP is 100% versus 50% of a capital gain.
So I guess to summarize all this, just to make sure our audience is aware of this, I mean, what are some of the risks, just to make sure we're aware of those, the risks associated with tax loss selling? What are some that you could maybe share with our audience?
So, okay, the first thing to remember is those rules. And those are the things that really end up creating issues for people. Because I think the hardest thing for people to wrap their minds around is that those 30-day time periods are from 30 days before you create the loss and 30 days after, okay? So the issue is that for a lot of people, they'll kind of forget that maybe they bought some shares 15 days ago and then, oh gee, those shares plummeted or something like that, and then they create this loss, and it's like, wait a minute, you know, they don't really realize that's enough to trigger it. The other issue is this associated situation where you may have spouses that, for example, let's say both spouses have DI accounts and they're doing their own thing within these accounts, and they don't realize that actually they've created a situation that has tripped up these rules. And as well, that added layer of a corporation that is controlled by either the taxpayer or the spouse also creating an issue. So that's where I see most of the mistakes made, because people forget that they're considered to be affiliated with their spouse and with corporations controlled by their spouses, and sometimes they're not keeping track of what each other is doing with these their respective shares, and that creates issues. As I said, it's even if you do trip the stop loss rules, it's not a tragic event forever, in that, you know, the loss is applied to the adjusted cost base of the new shares that you've completed, that you've received. So at the end of the day, once those shares are in turn sold, you do get benefit. It's just, most of the time this type of planning is done because the taxpayer wants an immediate benefit. They've triggered a whole bunch of gains at some point in the year that they realize they want to actually trigger some losses. And so that's where you just have to be careful.
Here at Direct Investing, we have a lot of day traders. Are they able to benefit from tax loss selling?
Well, when it comes to a day trader, what happens with someone like that is that the income that they may get from selling securities may not be considered what's known in tax as on account of capital. In that case, a day trader may actually, even if they're selling securities, which we're all used to, they buy shares in ABC stock and they sell them and they make a capital gain or a capital loss. In their case, their income actually might end up being considered business income. And that's something that a lot of people are a little confused about, because we're very used to the idea that, oh, if I own securities and I sell it, I automatically make a capital gain. We're used to those types of assets. Even, you know, for example, in real estate, we often think that, well, whenever you sell real estate, it's a capital gain. But under the Income Tax Act, that's not always true. There's a whole bunch of different things that, even though you are utilizing capital assets like shares, securities, mutual funds, ETFs, if you are doing it in a particular way, the Income Tax Act does not allow you to characterize that as a capital gain or loss, and it's actually business income. So then there's a whole different set of rules, a completely other seminar. There's a whole different set of rules that deals with that issue. So that's another thing that people have to be careful about if they do qualify as a day trader. This tax loss selling using capital losses may not be something that's available to them.
Okay, and is there any kind of definition of what a day trader is?
Actually, it's not in the Income Tax Act. What it is it's a series of rules that have been established through case law. They're actually called badges of trade. And it's the idea of, if you are doing certain things. Now, when it comes to day trading, there's a couple of rules that are very specific to them, such as, for example, how much knowledge you have about securities. But most of these rules deal with the frequency of transactions. I mean, are you somebody that basically sits at your computer all day and you're constantly buying and selling securities over and over? Do you have special knowledge in this area? Is this something, do you sort of hold yourself out to being somebody that actually knows about these sorts of things? So, and no one of these badges of trade is determinative to say, oh yes, this person now is a day trader. In law, it's considered what's known as a question of fact. It's something that you have to look at the activities of this person as a whole. And a lot of times, unfortunately, people don't realize that maybe they have now tipped over into day trading such that all of this income that they thought was a capital gain is now business income, until the CRA comes along and says, wait a minute, we've been seeing what you're doing and we're not comfortable with it. We think it's business income. Hopefully what we try to do is tell people that if you think maybe your activities are tipping over into that type of situation, you should go get good tax advice ahead of time and get an opinion. But it's not something that I can just point to a particular section of the Income Tax Act and say, this is going to make you a day trader. As I said, there's a big long list of these badges of trade. And it's not even a situation where I would say, well, if there's 14 of them and you have 8 of the 14, you're a day trader. It could be that you only have 4 of the 14, but those 4 are enough to push you over into that. So that's another thing, I suppose, when it comes to trading generally, that people should be aware of. Again, maybe something for another conversation, because it is an interesting topic.
Yeah, I mean, in the end, it takes just a lot of planning, just like all tax, yeah, tax planning. It's one aspect of it. I mean, well, while we have you here, I mean, are there any other items or to be better prepared for the upcoming tax season that you might recommend to our audience?
Yeah, so always keeping your receipts. So make sure that when you buy these stocks that you've kept the receipts and that you know, and if any of the fees. Now, usually if you're buying them with a investment advisor, then it's all recorded in it. But if you're switching from different platforms, different companies, then maybe the record keeping is not coming with it. So sometimes if you're transferring from one institution to another, now they've recorded your cost base or your book value as the value at the time that those securities transferred in. And so it's up to you to keep track of it. So make sure you keep track of it. When I was in public practice, I have had a few audits where they come back and they ask for the documentation. So keeping those statements, keeping the purchase records, showing the fees to them helps. When you're selling in that year, making sure you know what you've sold. If you itemize it, it's easier for accountants, or for you if you're doing your own tax return, but it's easier for the accountants the more that you've put together and saved. The other suggestion is start early thinking about it. Go to your advisors. Don't wait to the end of December. Go and discuss and show and see, and see what your income is going to look like in that year, and do your record of realized gains and losses. And then look at prior years if you do have mutual funds that are producing, and seeing where you are in that year, and just planning and helping, seeing if you're in a different bracket and maybe you want to come down. How much do you want to take your capital gains down? All that planning should be done early. So this is a great time of year to start thinking about it. Do not leave it to the last week of December. It takes a while to get, if you are going to sell something, to be able to sell it before the end of the year, to make sure it's in 2021 and not close in 2022. And just with COVID and people on holidays at Christmas and stuff like that, it might just take a bit longer.
Yeah, that's a good point. So in regards to the last day of the year, it has to actually settle before the end of the year, right? For it to be considered the 2021.
Yeah, you want to make sure it's settled in this year.
Okay. So, I mean, I see like planning ahead really helps in this tax loss selling. If you do want to be able to use this type of strategy, that the planning ahead comes kind of with that. Any other best practices we should be aware of, maybe just in general, other than what you've mentioned before?
So for the upcoming tax season, and I think, I mean, for me as a tax lawyer, I look at all of these options and opportunities a little bit more from a step back than perhaps, accountants who are sort of looking at day over or year over year planning. So I kind of look at these sorts of things over the course of a lifetime, because let's be honest, I mean, when you are actively trading in securities and this is something that you're managing your own portfolio, you don't really want to get into a situation where you have losses. And a lot of times, I mean, I'm not a person that knows a lot about the ins and outs specifically about trading. However, where I do see this happening more often than not is sort of when you first acquire the share of a particular company. In those early days, you acquire it, it might be going up and down, and so you might all of a sudden realize a loss. So I think from a planning perspective, it's of course to be mindful of the opportunity when it does arise, because a lot of times, as I said, it arises maybe in early days of owning a particular share. But again, be careful of those time limits, because if it is a security that you really do want to own, you have to be careful of those time limits. The other thing from a planning perspective, really, and again, this is more of the realm of a tax lawyer, is to look for historical opportunities to take advantage of tax loss selling, for example. I mean, we just had a historical event in March of last year, which created a reduction or a fall, for lack of a better word, in the market. In that case, there was a historical opportunity because of an outside event. And I think anybody that's been an investor for a long time knows that we have these situations that happen, and usually, hopefully, the market always rebounds eventually. But if you are, I want to say, brave during that time, you can look for an opportunity to sell a security that you have at a loss in order to realize that gain. But again, that doesn't mean that's an excuse to suddenly jump completely out of the market. I always look at these just from a tax perspective. So the idea is, yes, if there's something in your portfolio that can be used and you've realized gains this year or you have gains from other years, then take the opportunity, but be careful of those limits. And then look for historical opportunities over the lifetime of your investing life, and see if you can find opportunity there. Because as I said, for the most part, on a day-to-day basis, most people don't want to have losses in underperforming securities. And it's not something we seek to create. But where it comes up, be ready for it, because there is this good option there for you for planning. As long as you don't hit those time limits, if you have a loss that you create, you're entitled to it. So use it.
Tannis, Georgia, thank you so much for answering my questions. Now it's time for our audience questions. So for those of you in the live session, we'll now move on to the question session.